Welcome back to Smart Stock Sam, the channel where we cut through the noise, ignore the hype, and follow the actual money. Today, we are going deep on a stock that could either be the greatest comeback trade of 2026 or a slow-motion disaster that ends at zero. I am talking about DataVault AI, ticker symbol DVLT, currently trading at just 54 cents per share. And here is the question every single person who has ever looked at this chart wants answered. Is this a generational buying opportunity sitting right in front of us? Or is a $1 billion dilution machine about to absolutely obliterate whatever is left of this share price? We are going to answer that question today. And I promise you, the truth is far more complicated and far more interesting than anything you have read on Reddit. Let us start with the painful truth, because Smart Stock Sam never sugarcoats reality for you. Year to date, DVLT shareholders have been through an absolute bloodbath. The stock has plummeted 43.92%. Say that number out loud. Nearly 44% of your investment gone. And this was not just a random, senseless sell-off driven purely by bad news. This was what analysts call a perfect storm. A collision of massive equity dilution happening at the company level at the exact same moment that catastrophic macroeconomic shocks hit the entire risk asset universe simultaneously. Management is leaning hard into a very specific and very bold thesis, and they are calling it growth over ownership. The bet is simple in theory, but enormously risky in practice. Secure the highest value tokenization contracts on the market right now. Lock in non-dilutive partnerships before competitors even know what is happening, and trust that the long-term value created will eventually dramatically outweigh the pain of the share count expansion we have already seen. It is a bold bet. Whether it pays off depends entirely on what happens next. But to understand where we are going, you have to understand what broke the chart in the first place. Cast your mind back to April 2026. You had the total and complete collapse of peace negotiations in Islamabad, which rattled global markets. And then, almost immediately afterward, you had a naval blockade enforced across the Strait of Hormuz, one of the most critical energy choke points on the entire planet. Oil prices exploded past $100 per barrel virtually overnight. Now, what does an oil crisis in the Middle East have to do with a small-cap artificial intelligence infrastructure company trading on NASDAQ? Everything. Because when global uncertainty spikes to that level, institutional and retail investors alike enter what traders call a risk-off environment. Money flows out of speculative, high-beta positions and piles into safe havens like treasury bonds, gold, and dividend-paying blue chips. For a company like DVLT, which was already carrying elevated risk due to its capital structure, this macro environment did not just pressure the stock. It accelerated the downward momentum into a near freefall. The macro environment provided the spark, but the company's own capital decisions provided the fuel. And that is where this story gets genuinely controversial. Here is where you have to put your emotions aside and just look at the facts of what management has actually done. First, DataVault closed a $60 million direct offering, and in doing so, dumped 109.1 million shares into the open market at a discounted price of just 55 cents per share. Then, on top of that, they added another 75.9 million shares to complete their acquisition of a stake in Vivasource. And then, and this is the number that has sophisticated traders genuinely nervous, back in March 2026, they filed what is called an S-3 shelf registration. What does that mean in plain English? It means they have created a potential $1 billion war chest that allows them to issue new shares essentially whenever they want, at whatever price the market will bear. Analysts are specifically warning that if this shelf is tapped to its maximum capacity at anywhere near current prices, it could effectively triple the total share count, creating what would be an almost insurmountable structural ceiling on near-term price appreciation. Now, do you understand why the dilution question is so central to this entire story? But here is where the fundamental picture gets genuinely fascinating, because the business itself is doing something extraordinary underneath all of this financial engineering. In the fourth quarter of 2025, DataVault reported revenue of $33.82 million. That is a massive, beat-the-street number on the top line. However, and this is a very large however, the net income for that same period came in at just $661,000. Why such a thin profit on such strong revenue? Because their operating margin is currently sitting at negative 202%. The company is scaling its revenue so aggressively, so relentlessly, that its operational infrastructure simply cannot keep pace. Every dollar of growth is costing them more than $2 to produce. It is the definition of unsustainable in the short term. But here's the question you should be asking yourself. Is this a company in its death spiral? Or is this a company in the most painful and expensive phase of building something massive? Because those two things can look identical from the outside. Now let us talk about the battlefield, because right now, DVLT is a highly compressed spring, and the tension in this trade is almost visible. Short interest has ballooned to nearly 23% of the float, with over 81 million shares actively betting that this stock continues to crash. 81 million shares. Think about that. But here is the thing the bears might not have fully priced in. It is becoming extraordinarily expensive to hold those short positions. Annualized borrow rates are fluctuating as high as 20.23%. That means a short seller is paying over 20 cents on every borrowed dollar just to maintain their position. Every single day, the cost of being wrong compounds against them. And then there is the off-exchange activity metric, which is currently sitting at an extreme 65.29%. This tells sophisticated traders that the short sellers are being tightly squeezed into a very narrow exit. If a significant positive catalyst arrives, and one might be arriving very, very soon, 81 million shares will be trying to squeeze through a door that is only wide enough for a fraction of them. That is what a short squeeze looks like before it happens, and this setup has the architecture for one. So, if the shorts are under this much pressure, who is confidently sitting on the other side of this trade? This is arguably the most fascinating and contradictory element of the entire DVLT story, and it represents one of the most perplexing valuation gaps I have seen in the small-cap AI space this year. On one side of the ledger, you have what insiders are actually doing with their own shares. Over the last 6 months, there have been 20 insider sales and exactly 0 insider purchases. 0. The CEO has sold. Silex has sold. Normally, in any other stock, that level of insider distribution would be an immediate, non-negotiable red flag. But, and this is critical, on the exact opposite side of this ledger, you have BlackRock, Vanguard, and State Street aggressively increasing their holdings throughout the latter half of 2025. These are not momentum traders. These are not Reddit forum speculators. These are the most disciplined, data-driven, compliance-heavy institutions in the history of capital markets. They are essentially purchasing the liquidity that retail investors and insiders are providing. The question that should be keeping you up at night is, what are they looking at in their fundamental models that the rest of the market is currently ignoring? Now let us look at the technicals, because the chart tells a very specific story about where the battlegrounds are. The stock is currently trading at 54.22 cents, significantly below its 200-day moving average of $1.01.2 cents. That gap alone confirms a heavy, entrenched structural downtrend. The MACD is still technically flashing a sell signal, but here is the nuance that matters. The RSI, the Relative Strength Index, is beginning to stall and consolidate in the range between 37 and 47. When RSI starts to flatten out at these levels, it typically signals that the selling pressure is becoming exhausted, that the easy money on the short side has already been made, and that the market is entering a zone where buyers are starting to test the waters. However, and this cannot be overstated, there is a hard, ticking deadline hanging over this entire situation. Because the stock is trading below $1 per share, DataVault faces a firm NASDAQ compliance deadline of August 24, 2026. If the price does not recover organically before that date, the dreaded R word enters the conversation: a reverse split, and even the possibility of a reverse split can create a devastating overhang of fear on a stock's price. Despite a brutal 21.5% drop over the preceding week, DVLT actually posted a 5.42% daily gain on the most recent Friday session, a meaningful signal that buyers are beginning to defend specific price levels. Immediate support sits at 46.8 cents. The line in the sand for the bulls, however, is the stronger structural floor at 30 cents. That is the level that, if broken, opens the door to a genuinely catastrophic outcome. On the upside, the first major hurdle is the 63.4-cent pivot that has to be reclaimed before any serious conversation about a trend reversal can begin. The resistance level that would truly validate a recovery and likely trigger that short squeeze is 96.4 cents. Reaching that level would be the boss fight of this trade. But here is the big why. The fundamental reason that institutional investors may be willing to endure all of this volatility and uncertainty. In just the first quarter of 2026 alone, DataVault secured $750 million in tokenization contracts. $750 million. Their total recognized revenue target for the entire year is $200 million. That means their current contracted backlog represents nearly 400% of their full-year goal. The demand for what they are building is not in question. The only variable left, the only thing the market is actually waiting to see, is whether management can execute. Because if they can convert even a meaningful fraction of that backlog into recognized revenue, the current market capitalization of this company looks like an absolute rounding error in the footnotes. And the company is finally addressing its biggest weakness. Management recently announced a $120 million cash contribution from Silex to fund their 100-city GPU network rollout. And the two most important words in that announcement are non-dilutive. This is a revenue participation model. They get the capital they desperately need to build the infrastructure without issuing a single new share and without tapping even a single dollar of that $1 billion S3 shelf we discussed. This is the first concrete sign that management has heard the shareholder community's concerns about dilution and is actively structuring deals to address them. Beyond that, management is pursuing two value-unlocking initiatives that the market has not even begun to price in. First, they are planning a dividend spin-out of their acoustic sciences division into a brand new standalone public company called API Media. If you are a current shareholder, this is a direct benefit to you. It is designed to compartmentalize value and distribute shares of a separate listed entity directly into your brokerage account. Second, they have signed a binding acquisition agreement for CyberCatch at a purchase price of approximately 136.8 million Canadian dollars, bringing quantum-resistant AI security capabilities inside the DataVault ecosystem. They are deliberately building a technological moat, and the market has simply not priced that moat in yet. So what is the gap between current price and what analysts believe this is actually worth? The current market reality is 54 cents per share. Maxim Group, a Wall Street firm with a formal buy rating on the stock, has set a price target of $3 even. And Simply Wall Street's intrinsic value model, based on the projected revenue pipeline, places fair value at $4.20 per share. That is an implied undervaluation of 86.5% from today's price. You are being offered a chance to buy $1 for approximately 13 cents, provided the company can execute on what it has promised. For those who are considering a position, the current entry zone sits between 50 cents and 54 cents, right at the current support structure. A conservative price target for the trade is 79.8 cents, a breakout above the immediate resistance pivot. If the upcoming earnings call is truly a home run, the aggressive target is a reversion toward the 200-day moving average at $1 and 1.2 cents. But discipline is everything here. A strict stop loss must be set below 46 cents to protect capital from a potential breakdown toward that 30-cent structural floor. Which brings us to the single most important event in this entire story. May 15th, 2026, the earnings call. This is the binary event. Management must accomplish exactly two things to restore confidence and ignite a recovery. Number one, they must present audited, verifiable revenue flow from their GPU deployments that validates the $200 million annual guidance, not projected, not anticipated, actual, recognized, audited revenue. Number two, the CEO must publicly, unambiguously, and definitively reaffirm his no reverse split promise. If both of those boxes are checked, the combination of extreme short interest, an oversold RSI, and that massive contracted backlog creates the conditions for a significant relief rally. If either of those boxes goes unchecked, this chart has a lot further to fall. Now, a word before we wrap up, because SmartStock Sam is committed to giving it to you straight every single time. Nothing discussed in this video is financial advice. I am not a licensed financial advisor. This content is for educational and informational purposes only. The information presented here is based on publicly available data and analyst research, but that data can change rapidly. All investing involves risk, and speculative small-cap stocks like DVLT carry significantly elevated risk compared to the broader market. You could lose your entire investment. Always conduct your own due diligence. Consult with a qualified financial professional before making any investment decisions, and never invest money you cannot afford to lose entirely. The verdict on DVLT is genuinely not yet written. This is a company with explosive demand, institutional backing, and a binary catalyst days away, but also with aggressive dilution history, severe operational losses, and a compliance clock that is ticking loudly. The story is not black and white. It is complicated, layered, and frankly, that is exactly what makes it so compelling to analyze. Now here is the question I want you to sit with and answer in the comments below. If management delivers on both the revenue validation and the no reverse split promise this Friday, do you believe institutional accumulation alone is enough to trigger a genuine short squeeze? Or do you think the dilution overhang will cap any real recovery regardless of the catalyst? Drop your honest take below. I read every comment personally and will be responding throughout the week. If you found this analysis valuable, please hit that like button right now. It genuinely helps this channel reach more investors who need to hear the full picture rather than the hype. Subscribe to SmartStock Sam if you are not already part of the community, because we cover situations exactly like this one every single week with the same depth and the same honesty. And if this video gave you real value today, consider supporting the channel directly through YouTube's Super Thanks feature. Every contribution helps me produce more of this kind of in-depth, independent research for you. I will see you in the next one.